watching Bloomberg Quint. India's economic growth slowed sharply in the first quarter of FY20. GDP growth came in at a six-year low of 5% versus 5.8% in Q4. Gross value-added growth also fell to 4.9% in the first three quarters. Let's try and get some analysis and understand what's going in to the economy right now. Joining us first off is Dr. Ashima Goyal of the Prime Minister's Economic Advisory Council. Dr. Goyal, thanks so much for taking the time to speak to us. Ma'am, let me first ask you, what is your analysis of the numbers as you've seen them?
Yes, it's clear that there is a slowdown. And when I read the numbers, I see that manufacturing is under stress, and construction. And we know that there was a slowdown in credit. We know the automobile slowdown. We know that there are problems in certain housing companies and in purchase transactions and in completing. So these figures highlight areas where you need immediate attention. But the figures also suggest, for example, this manufacturing slowdown is partly a base effect because there was a huge 12% growth in the last quarter this year. And I see that government spending is maintained. We must remember that this quarter was the quarter in which elections took place. And so there was a postponement of investment, stalling of expenditure, government expenditure. So what is hopeful for me in the figures is that there's not so much slowdown in consumption as a share of GDP. Because there's this belief that the consumption story is running out of steam. But it seems to me that the consumption story is intact. There has been a slowdown because of credit issues. And then that we know that the government spending had slowed down before the elections. But the overall share in GDP has not gone down that much. So again, it suggests there's probably a revival in government expenditure in June. After the election, as the new government came in, we know in July it is definitely there. So I believe that it's a bottom there, and we should see the economy looking up after this. It's a number of measures announced for liquidity for NBFCs to allow them to lend to the stress, to allow lending to the stress sectors to resume. All that should help. Yeah.
Ma'am, actually, if you look at the expenditure side data, the private final consumption expenditure growth is just 3.1%. I believe that's an 18-quarter low. So it's tough to understand why one would be, in a position to be optimistic about consumption. 3.1% on consumption, which is 57% of our economy, is worrying.
Yeah, but I see that as a ratio of GDP. Government and private final consumption expenditure is 55.1, compared to 56.1 in the last quarter. Sure. So, 55% of GDP is quite a lot. I think for the same thing, when we say that investment has really slowed. Now, gross fixed capital formations, it was 32.8 in the last quarter. Now it's 32.5. Now, if your fixed capital formation is at 32.5% of GDP. Very few countries have such a high number. Then to say that investment has just stalled will not be correct. There was a slowdown. There was a postponement of projects. But in some sectors where there are capacity bottlenecks and with interest rates coming down, we should see a revival. I don't see signs of an absolute collapse in these figures. As I said, manufacturing
consumption numbers, if I may request you to focus on them, just to tell you, consumption, private consumption final expenditure was growing at almost 10% in the fourth quarter of FY18. From there, we are down to 3.1% growth, ma'am. And, the initial analysis was that the slowdown is only in the rural economy. But at 3.1% growth, clearly there is something else happening out there on the consumption side, which is now getting captured in the data.
True, I agree. There was a slowdown in credit since the end of 2018 for consumer durables. We are seeing the effect in car sales, for example, and other durables. But we are seeing a slowdown in non-durables also. But then we know that there was a distress in the agricultural sector. We are seeing that over here, a fall in agricultural growth rates also from 5 to 2%. Yeah. So, but then now the monsoon has recovered, and there are a number of sort of transfer schemes and transferring money to farm households, which should be taking effect. So we should see a recovery. I agree that there's a slowdown in consumption, but you cannot say that what I'm saying is that you cannot say the Indian consumption growth story has stalled, or because that's our fundamental, our demography. And the other reason is, of course, if job growth slows with the slowdown in industry, then people have lower incomes, they consume less, so on. I think we should wait for the next quarter, especially the festival season, and see what happens to consumption there. In general, this was a very uncertain quarter. The election quarter is a very bitter campaign leading to it, a lot of uncertainty on what would happen, and people were postponing purchases. So I don't think we should try to work out long-term trends based on what happened in that quarter. It was a very, very unusual quarter.
Sure. Ma'am, if one just puts together the three components, again, I'm sticking with the expenditure side data. Private consumption has been weak. I think capacity utilization numbers had started to pick up. The last round suggested that seasonally adjusted capacity utilization has also come off a little bit. Now, if consumption is weak, perhaps there's no reason to expect a significant pickup on the private investment side immediately. Government spending, I'm not sure how much headroom they have, although some budgeted spending will come in. What would you expect the trajectory of then growth to look like over the rest of the year?
Yeah, so for government spending, I would say that if you see this government, they always spend more in the first two quarters. And then they are keen to meet the fiscal deficit target, so they slow down in the next two. And now, they have this money transferred from the RBI, which can allow them to spend before tax revenues. Yeah, they can prepone spending, and that can give a boost to the economy without raising interest rates through the G-Secs. The other positive I would like to say is that the RBI rate cuts, not only the rate cuts, but also liquidity and surplus. According to me, a major reason for the slowdown, and I've been pointing to it in my writings and etc., is that you not only had a sectoral liquidity crisis with NBFCs, they were finding it difficult to get liquidity, but at the same time, because there were large outflows, with the volatility in oil prices in 2018, aggregate liquidity went down. It was in deficit. And so you had a combination of a liquidity squeeze, which really dried money in the system and therefore spending. But it's only in June that aggregate liquidity has gone to surplus, and there were a few measures undertaken to provide liquidity to NBFCs. They're not very successful because banks are reluctant to lend, they're cautious. But now there's a greater realization of the seriousness of the problem, and more steps, new measures are being announced every week. So I think the government is responding strongly now. And we should see just the surplus liquidity. People say it was demonetization which brought down growth. But just after demonetization, the rate of growth reached 8.2%. Why? Because there was huge surplus liquidity with the banks. They were lending to NBFCs. Mutual funds had huge money coming in. They were lending also. So when there is large liquidity and rates are low, my research suggests that the pass-through can be quite rapid. So we are seeing a reversal of those tight liquidity conditions, and that should lead to higher growth. So your question about what I see the trajectory over the rest of the year, we are seeing a turnaround, say in July. Liquidity became surplus only in June. Yeah, so it will take a few months to have effect. I think we can recover to about 6% growth, and then by Q3 maybe a little higher. Yeah.
All right, ma'am, just one last quick question. Monetary, as you said, perhaps easy liquidity plus lower repo rates will feed through, at least on the banking side. Bond markets have their own sort of credit risk issues right now. Do you see any need for traditional fiscal stimulus? Some would say that there is a little bit more room now that there's a large transfer from the RBI that's come in. Do you see the need for it? So that transfer will help them to spend, as I said, without really going in for a fiscal deficit immediately. The point is that they are committed to the FRBM, which is a legislative thing that binds them. So we're waiting for the Finance Commission if they relook this. I think there is scope for counter-cyclical deficit, but then that has to be enshrined in the law, right? The FRBM has to be accordingly amended. If it is amended, they have room to spend. Otherwise, I believe they don't want to depart from that. All right, Dr. Goyal, thank you so much for taking the time to speak to us. That's Dr. Ashima Goyal.
Bye.
Bye-bye. Let me go across now to Siddhartha Sanyal, Chief Economist, Head of Research at Bandhan Bank, and DK Joshi at CRISIL. Very sorry to have kept both of you waiting. It's been a slightly hectic day with a bunch of announcements. Mr. Joshi, let me start with you, sir, first. You've seen the numbers by now. What stands out with the consumption numbers or more?
Well, I think what really stands out is the fall in private consumption growth, because it has been the bulwark for the last couple of years. And private consumption to GDP ratio, which was falling from 70s onwards, I think it had started rising. So this was supporting the economy, and households were saving less. They were leveraging themselves to support their consumption. But now I think with the sharp decline in consumption, private consumption in this quarter, I think the opportunity to leverage has reduced, and I think some impact of falling incomes as well as the GDP falls. So clearly, I think private consumption to me is a worry, because private investment revival, you require capacity utilization to improve further, and it, as you were pointing out earlier, it was improving, and now I think with this kind of private consumption growth, I think the process will slow down. So clearly, I think private consumption is something to worry about at this juncture, and the other worry is on the external front, I think, which people are not talking about. The exports as well as imports of at least merchandise goods in the first quarter were negative. I mean, and I think that was pointing towards an impending weakness in the first quarter. And and there are a lot of risks from the external environment that could play out, I think, going ahead. So clearly, if I want to look ahead from this point, I mean, it's not that everything is bleak. We've got near normal or normal monsoons, actually, though there is some spatial distribution, temporal distribution issue. But despite that, I think the monsoons have been normal. The oil prices are still very well behaved. And the monetary transmission, even though anemic, but has at least started picking up. So all these things should prevent the growth from falling further, and actually will create an upside to it towards the third and the fourth quarter. How much will the GDP go up going ahead? I think that we are in the process of re-looking at the numbers, and probably will come out with a revised estimate soon.
Yeah, I think the RBI will have to as well. Siddharth, if you want to jump in on both the consumption side, also the manufacturing number is again very weak. I don't have the data, but this would be the lowest in a while, no?
Very clearly, manufacturing growth number had been pretty weak. I have heard some of the government officials flagging the good number of electricity growth. Yes, indeed, that has been some kind of a positive number in the overall pack. But if I look at a variety of numbers, for example, construction, etc., also, which had been showing some bit of resilience in the past few quarters, again in this particular quarter is weak. On the expenditure side, consumption number is a big worry. But at the same time, even if government spending has been relatively strong, the numbers, the low consumption numbers are having its toll. Also, very importantly, if I look at exports and imports on a net export basis, in this particular quarter, we are actually seeing some kind of a favorable impact compared to a significantly negative net exports. We are seeing some kind of a positive net exports figure in this particular quarter, and which is acting as some kind of a savior. Otherwise, the number could have been somewhat more ugly. But overall, there had been quite a few pressure points.
Mr. Joshi, if I could come to you on a combination of both the export numbers and the manufacturing side, if you put the two together. Now, we don't have any employment data, but yesterday in the RBI's annual report, they talked about the fact that a consistent slowdown in manufacturing obviously has a bearing on employment and hence wages and eventually spending. Is that sort of the cycle that is playing out on the urban side? I think we have probably a clearer fix of what's happening on the rural side, but on the urban side, it seems like the theme now is perhaps weaker employment growth or weaker wage growth, plus lack of leverage consumption because of NBFCs, which is now meaning slower consumption growth on both urban and rural.
See, what we have information is on the leverage consumption. Definitely, I think the NBFCs did play a role there. And but I think since we were at manufacturing, I just wanted to point out that we did see manufacturing growth of minus 1.7% in the first quarter of 2017-18. So it's not the weakest in last couple of years. So that was immediately after demonetization. Now I think the rural part was easily explainable, as you said, but I think the urban part is, from a consumption perspective, is a little hard to explain because of the lack of information. You only have some proxy indicators which were pointing out. So I think the car sales not being there, and I think and also I think some other consumer durable FMCG weakening. So I think all that was pointing towards the weakness that was emerging. But a clear bifurcation of rural and urban is a little difficult. We only have some proximate indicators to point, and they were pointing towards emerging weakness in urban areas also.
Siddhartha, what is your analysis of what's feeding into this consumption side? I'm sorry, I'm focusing on that, but it has been perhaps the strongest going part of the Indian economy. So if that starts to give in as well, then we need to really worry.
No, absolutely, and that's a very, very valid concern. My sense is that you are seeing quite a bit of drop in consumption momentum so far as the large ticket goods are concerned, and that's why you get to see all these automobile numbers to be pretty bad, some of the consumer durables to be pretty bad. And in fact, here one important factor had been the NBFCs in the recent past had been quite a significant conduit towards some kind of mid-sized consumption, consumer durable purchases, etc. Possibly that is also playing its role. Interestingly, we are not seeing that much of slowdown, despite some of the FMCG companies flagging their concerns. I'm taking that into account. Despite that, I would tend to say that we are not seeing that much of cut down in essential consumption. In fact, in segments of the weaker section of the rural population, our sense is that economic activity momentum is pretty decent. So we are not seeing that kind of slowdown in that particular segment. Possibly they're somewhat farther away from the the mainstream formal sector, and the slowdown is much more in the formal sector, leverage sector, someone exposed to leverage consumption, etc. But in the real bottom of the pyramid, it's possibly slightly more insulated at this moment.
Okay. Mr. Joshi, on the services side, again, this is something you had pointed out in an earlier conversation as well. Now I'm switching over to the sectoral data. What do you see on the services side?
Well, I think services weakness has continued. I mean, if you look at telecom, if you look at airlines, I think there were some incidents that happened. I think telecom is suffering from extreme competition. So when the manufacturing slows down, that also spills over to services segment, because some of the services are geared towards manufacturing activities. So clearly, I think services, the only part of the services which is holding on is the government, I mean public administration and defense. So I think in the last quarter, which is the fourth quarter of 18-19, the services was still stronger. Actually, it was growing quite fast. I think now that is also slowed down. So I think this is except for government services, I think most of the services are weak. I think if I may just add to the earlier question that you had asked, I think I just remembered that if we looked at the income growth of listed companies, I think the salary and wages, I think they had also slowed down in the nominal terms. And if you saw the real estate, the very fact that there were fewer and fewer launches, I think was also pointing towards a weakening of demand, particularly in the urban area. So there are some proximate indicators which pointed towards that. So clear, I think in this environment, I think it's the agriculture which might do well this year in rest of the quarters. But as far as the manufacturing, etc. are concerned, the second quarter also is likely to remain weak, and the services weakness will only start reducing after the third and fourth quarters. Once banks start lending, and also I think the
No, sorry, Mr. Joshi, finish please.
No, no, that's okay. I mean, when the NBFC, I think stress also starts reducing a little bit. So we might see the services segment come out of the current blues.
All right. No, I'm just pointing out to you because as we were talking, Niranjan Radharaksha, who both of you know well, just pointed out that nominal GDP growth was 8% in Q1. Siddhartha, 8% nominal GDP growth.
Yeah, very, very clearly, this we are in a phase when both GDP growth momentum as well as inflation momentum is relatively weak. So always we have discussed the evils of high inflation in the Indian context, and we have actually entered into a phase where inflation is actually pretty low. But at the same time, when you think in terms of from micro business point of view or business entities microeconomics point of view, I mean, a lot of business managers will be thinking in terms of nominal growth rate and not necessarily in terms of real growth rate. Agreed that within that mix, it's very important that the real growth rate remains very high, but at least they first need to see the nominal growth rate going good. But in this kind of a situation where we are seeing, pressure on both for the economy as a whole, this is a significant headwind for a quick recovery. So our sense is that even though numbers might improve at the margin from this point onwards, any meaningful recovery in the overall momentum, you might have to wait for at least a quarter and a half, if not slightly longer. And the current set of forecasts which we have for FY19-20 GDP growth for some of, say, from RBI or some the survey of provisional forecasters, which are more at the high 6% kind of range or zone close to 7%, I think there can be significant softening in that particular expectation over the course of the next few weeks and months.
All right, I think I'll leave this conversation for now. We'll all go back to our desks, do a little bit more number crunching and come back to you. But Siddhartha, Mr. Joshi, thank you so much for joining us here on this quick analysis on GDP data. 5% growth headline number, much lower than what anybody had expected, 4.9% GDP growth. And as we pointed out in the course of the show, 8% nominal GDP growth. That's not looking good from any angle. Thanks for watching Bloomberg Quint. A lot more analysis on the website. Do go read.